Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 258 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark.
How are we doing today?
We're doing good. And in the quarter, baby.
Yeah, on Friday. Yeah, because next Monday is July 1st, which year just keeps going quicker and quicker.
I know. So we got today and tomorrow, 2 trading days left in the quarter.
2 days left. So as always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts, and as of the market close on Wednesday, June 26th, S&P 500 index up 3.8% for the month and up 14.8% for the year. The Dow Jones Industrial Average up 1.1% for the month and up 3.8% for the year. The Nasdaq Composite Index up 6.4% for the month and up 18.6% for the year. The Russell 2000 Small Cap Index down 2.8% for the month and down 0.3% for the year. And the Vanguard All World X United States ETF down 1.6% for the month and up 4.2% for the year. 3-month Treasury rate at 5.5%, the 2-year Treasury rate at 4.71%, and the 10-year Treasury rate at 4.32%. Moving on to big headlines, current events from the week. Only thing we have for listeners today is just an update on home pricing. So the S&P Case-Shiller Home Price Index for April was up 6.3% year over year and up 0.26% month over month for the 15th consecutive month over month increase. So this is just an index that tracks home prices nationwide, just not showing signs of slowing down anytime soon.
It's interesting, and I agree with kind of these data sets. The one data set that's concerning is the inventory level. And I'm going to highlight it on the next podcast. It caught my eye last night. The amount of homes for sale nationwide, I think, is going to surprise people in context of the last 10, 15 years. It's at almost a high point.
Yeah, I've been seeing a lot of that stuff on Twitter, especially seeing things in Florida about inventories being abnormally high. So
yeah, it's interesting. It hasn't really hit prices yet, but what normally happens, Mark, when you have excess supply?
Prices come down.
Right. So I'll be curious to see if we start to see that, or it's just because of the inflationary environment we're in, physical assets like real estate have a tailwind.
Right.
We're about to find out.
Yeah. Should be interesting from between now and the end of the year and the first part of next year.
Absolutely.
Moving on to tweets, articles, and research from this week. First thing that I had was an article from Carl Swenlin on stockcharts.com titled Deja.com Disaster, ? So definitely a clickbaity headline, but I just wanted
click
to
on that. You clicked on it, didn't you?
I did. Of course I did.
I love it.
So I want to use this more as just a friendly reminder that some of the best companies in the world have suffered massive drawdowns in their history. Okay, so
I love where you're going with this.
A couple charts that I want to pull up, and Jenna will throw up on the YouTube video and in our show notes. The first chart is Apple, Matt.
Okay.
And back in the early 2000s, from about 2000 to 2002, Apple, which, as many would argue, is one of, if not the most successful company in the world, had a 82% drawdown. God, my eyes are getting old. I'm getting old. 82% drawdown. So from peak to trough, from Apple's high in 2000 to the bottom level that it hit before it started going up again, it fell 82%. And that's now one of the best companies in the world.
Yeah.
Right.
And you know what started turning around? They started to sell the, I forget what it's called now, the digital music player. It wasn't a phone. It just held, what was it called, Jenna? The iPod.
The iPod, yeah.
The iPods would turn that thing around.
Had like the scroll wheel on it. Yeah,
I still remember to this day people calling in the brokerage firm to buy Apple stock because they're like, the iPad is going to change Apple's future.
Yeah. Yeah, it's interesting. And now it's everything.
Yeah,
from,
Steve Jobs turned that thing around.
From the phone. Yeah, for sure.
But that's a tremendous sell-off. 82%, Mark.
82%.
82. And the question is how many people had the diamond hands to hold that stock through that downturn?
Correct. And right below it, another example is Amazon fell 95%.
95%
from its high. How many investors can sit through something like that?
What's the recovery number to get back to break even? What's the return if you're down 95, Mark? It's in the hundreds of percents, right?
Oh yeah.
You're like 400 or 500%. You'd have to like, maybe
because
more.
if a stock falls like 10%, you have to. It's like 11.7% or almost 12% you have to make to get back to that level. So, I think sometimes investors are like, well, why didn't we buy Amazon or Apple back in the early 2000s and have just held it up until this point?
Yeah.
And obviously, hindsight's 2020. Looking back on it, that's great. But at the time when Apple or Amazon, for example, is maybe a decent chunk of your account and they're down 82% and 95% respectively, it's not going to be a fun year.
No, sir.
At all.
No, sir.
That's your account almost going to zero.
There's this Denzel Washington movie where the guy's like, "You having fun now? You having fun now?"
Right.
He's like, "Yes, no, you're not. You're not having fun."
It's just a really fine line that I think we as wealth managers and investors in general have to balance. Is yes, the longer you go out on the time horizon and the longer you hold something, the higher chance of having a substantially larger return.
Sure.
But the flip side of that is you got to go through some serious pain to get there. It's not all rainbows and butterflies, holding something for 20 years.
Absolutely.
So, and then two other charts that they had in here was Cisco. Cisco fell 90% from its high in the early 2000s, and literally is still not back above that level. So that's, 20 plus years that Cisco, if you bought it
at the high,
you're still underwater or pretty much break even right now. Not including dividends, but Intel was another big favorite back in the day, big semiconductor company, fell 83% for the highs, and it took 18 years to recover. So, just because something falls aggressively doesn't mean it recovers in the next 1 year, 2 years, 3, 4, 5 years even. Intel, which was one of the heavyweights back in the early 2000s, right?
You're doing great, yeah.
Took 18 years to make a new high.
18 years.
So, everyone having the mantra of, well, just buy the dip, just buy the dip, just buy the dip. It works until it doesn't.
That's also true. Yes.
So yeah, I just thought that it was a nice conversation starter with this article with some of those charts. So I encourage you to check those out if you are just listening.
This is not necessarily a hot take, and I don't use the word guarantee very often, but right now a lot of these AI related stocks, I'll pick the poster child you keep hearing about in the news, NVIDIA. At some point, I guarantee there's going to be a major drawdown in a stock like NVIDIA. Okay.
Yeah. Oh, yeah.
And the question is people then will look back as you insinuated. Let's just say it's 10 years from now. And let's just say, the previous 10-year return is X% per year. The question is can they withstand a 20, 30, 40, 50, 60% plus downturn in that name to realize those longer term averages? And you and I have been doing this long enough to know that the average investor cannot.
Right.
Which makes those sell-offs what they are. That's why things perpetuate. Oh, I can't let this go down anymore. I got to sell. Selling causes selling, just as we're in a market right now where FOMO's in place and buying is causing buying.
Yeah. Yeah, for sure. And, NVIDIA is a name that, a 30% loss or a 30% pullback can turn into a 60% pullback pretty quick.
Absolutely. So I guess the message is expect that at some point.
Yeah.
Have the proper time horizon with securities like that. That's the words of wisdom.
Right. And, when you hear people talking about a certain stock or a certain index or an ETF that's down, 30% from the highs, that does not mean rush in and all the cash that you have and buy it. It's like if you have a plan on, we're going to keep adding to this position as it gets cheaper and cheaper, that's fine. but you just can't let that get too large of a position, because like I just said, that loss that you think is the bottom could double from there.
Absolutely,
very
sir.
quickly.
Yeah,
So,
well said. Well said.
next thing I had was a chart from Adam Turnquist with LPL on June 24th. And he's talking about the seasonality of the volatility index. So volatility index, the metric that we use, or the instrument that we use, is called the VIX. So it's a volatility measure based on options contracts for the S&P 500. So all that people really need to know is that when the VIX is elevated or rising, usually we're in a weak market environment. When the VIX is subdued or falling, usually we're in a strong market environment for stocks. So if you look at this chart, the seasonality of the VIX during election years is in orange. The VIX year to date is in light blue, and the average VIX over the course of a year from 1990 through today, or through June 20th, is in black or dark blue. And as you can see pretty clearly on this chart, Matt, typically the year starts off with a little bit of volatility, and then, February through kind of the middle of the year, a little more than the middle of the year, tends to be pretty calm. Volatility is falling. But then right around the end of summer, early fall, we see volatility start to pick back up, and especially during election years, right? Yeah. So as you can see, we're at this period where we're not too far away from the point where we would expect some volatility to come back into the market. My best guess, sometime in early September, late September, I think you might start to see some of this come to fruition. And it's no different from what we've been talking about all year, is we are expecting volatility in the markets before the election. It's just a matter of when, in my opinion.
Well said. Well said. Is Adam bugging our office? Because we had a conversation about volatility, especially in election years, just a couple days ago, like 3-4 days ago.
And we've talked about it, and we did some other clips on it on our social media website. So possibly.
I think it's just good to telegraph this, because seasonality is an important data point that our listeners and viewers should be paying attention to. And my other comment is, as long as the presidential ticket remains the two candidates that we have right now in the Republican and Democratic Party, I think there's a lot of predictability with their policies. I think we might not have as much volatility as we've had, say, in the last 4 presidential election years. However, if one of the two candidates is not on the ticket for whatever reason, I would expect higher volatility compared to the last 4 presidential election
Yeah, because
years.
at least, obviously it's not the whole reason the market's doing what it's doing right now. But, to a certain extent, the market has priced in a Trump versus Biden ticket, right? Yeah. So first presidential debate tonight.
Yeah, that's going to be interesting. I'm definitely going to have some popcorn ready. It's interesting how many people can and cannot sit in the room with their significant other and watch a debate. Have you heard people talk about this? Yeah. Are you and Ken's ones that can sit in the same room?
We can sit in the same room. Yeah. I wouldn't say that we have extremely aligned views, but yeah, we can sit in the same room.
I would say early on in my marriage, it was not a wise decision for me. And now we're definitely at the point where we can sit together, and I'm trying to
now it's just kind of like a comedy show, right?
Oh, it's definitely
and
a stand-up.
You sent me something last night about someone tweeting. There's literally, you can bet on certain things happening or not happening during the presidential debates.
This is so true.
My favorite was Trump to say the words bingo bongo.
Was plus 2,000?
Plus 2,000 or something like that, which I just thought was unbelievably funny.
There was things about one of them falling asleep, one of them falling, one of them, I forget what the other things were. They were just so outlandish things.
Yeah, it was hilarious.
I'm sure one of them's going to pay.
Yeah, I'm sure they will. Last thing I have is a graphic from a blog post from Ben Carlson on his blog, A Wealth of Common Sense. This was back on June 18th. That shows the average annualized performance of companies before and after the first year they become one of the 10 largest stocks in the U.S.
This will be very interesting.
So Jenna will throw this up on the YouTube video and in our show notes. And you can see in this chart It goes all the way from 10 years before companies becoming one of the 10 largest in the U.S. and 10 years after. And you can see pretty clearly, Matt, that, leading up to being one of the largest companies, performance is strong, which you would expect that, right?
Yes,
because
sir. In
order to become one of the largest companies, performance
better be
needs
rallying,
to be
baby.
good. So I don't think that really would surprise anybody. But as you can see on the right-hand side of this graph, after they become one of the largest companies in the U.S., performance looks pretty weak on average, right? So I think a lot of people are looking at this and asking the question of, okay, well, what's going to happen to Apple, Amazon, Nvidia, Tesla in the next 10 years? Are they going to follow suit? And obviously the question at this point is, I don't know, but, just interesting that once they do become a pretty large piece of major U.S. indices, performance does tend to tail off a little bit.
When I see this, two thoughts come to mind. The first is when you become, especially in the top 5, the overall movements of the market because of the popularity of indexing is going to really predicate the supply and demand metrics of your stock. And what I mean by that is you have so much money that is indexed that your stock could be killing it. But if everyone's selling the market at that point, you're going to have an immense amount of selling pressure on your name. I've seen instances over the years where I'll just use Apple as an example, not a recommendation for or against. When they were kind of releasing the iPhone initially, the company's earnings were killing it and the stock was still down because there was so much selling pressure on the market and it was a large piece. So that's one of the things you got to remember. The second thing it brings to mind is, we talked about this in the podcast previously, go back 30, 40, 50 years and look at the top 10 names in the S&P 500 and fast forward to today and how many of those names are there. And when we look at the top 10 right now, it's easy to sit here and think there's no way fill in the blank is not going to be in the top 10 in 20, 30, 40 years. And I think that's a narrative that needs to be challenged. I know that XYZ, let's just fill in the blank with some of the top boys right now and girls, Amazon, Apple, etc. Are they going to be in the top 10 in 30, 40 years? Not guaranteed.
Mm-hmm.
Not guaranteed.
And history would say probably not.
History would say probably not. Someone could sit here and say, well, look at the balance sheet, the moat that they have, etc. But, you got to look at history and say that might not be the case.
Mm-hmm. Yeah. So, and just, as companies mature and get larger, their growth tends to slow.
It does.
And, they're no longer viewed as this, high growing small company anymore.
Yeah.
What they once were. So it kind of just makes sense to me in general.
That was a good piece you picked.
Yeah,
I like that.
It was a good graph. So
good piece.
I will turn it over to you.
All right, 3 pieces this week for our listeners and viewers. Mark, first is the Nasdaq due for a seasonal run here in early July? I had a piece about this about a month ago on the podcast. There was a note that I was able to grab from the Goldman Sachs trading desk alluding to the seasonality that's about to come up. This piece was posted by Jeffrey Hirsch. He's the CEO of Hirsch Holdings, and he's the publisher of the Almanac Trader, which I know that you
do enjoy that.
You do enjoy that. Mm-hmm. This post, Mark, was from June 24th, sir. And this is from the Almanac Trader. And it says, and I quote, Christmas in July. You like Christmas in July, don't you, Mark?
I do.
It says the Qs, QQQ, which is the popular ETF that tracks the Nasdaq 100, says weakness setting up Nasdaq's mid-year rally, 12-day run up 30 of 39 years. Average gain, 2.5%. Look for this rally to begin around June 26th and run till about June 12th. And again, he's talking about seasonality.
July 12th.
What did I say?
June.
Oh, I apologize. July.
We're going backwards.
We're going backwards. Now, Jenna will put up this chart for our YouTube viewers. This will be in our show notes. This is pretty neat. And it's from the Almanac Trader, and it shows seasonality movements of the market, the Nasdaq, Mark. And you can see the period that is emphasized and highlighted, which is this seasonal run that you tend to see around this time of the year. So it's just interesting. Seasonality is definitely an important data point. Does this guarantee the market's going to be up during this period? Absolutely not. But it looks like, tongue-in-cheek, about a 75% chance when you look at history, tends to be a stronger period. Your comments?
Yeah, I think it's just interesting that kind of after this push higher in June and July, you tend to get some sideways chop in the Nasdaq for the next couple of months until you get that year-end rally. So
well said.
Yeah.
And you sideways for, as you were kind of indicating, 3 to 4 months.
Yeah.
Kind of expect
October,
that.
right?
My next piece is
which is what really we saw last year, right? It was like
correct
end of July, and then market bottom. I think it was like pretty much the last day of October.
Yeah. And strong rally in November, December.
Yeah.
So I know we're kind of sick about talking about market breadth, but I do have another piece. So I'm just like adding to the problem, and I'm sorry. Okay. So the next piece is from Seth Golden, and I wanted to highlight this because there is a lot of narratives in the market that are kind of indicating, or I should say, Mark, emphasizing that if you have poor market breadth, meaning there is just minimal participation of stocks moving higher, it virtually guarantees a massive sell-off is on the horizon. And you can see kind of my tone. This is the narrative that's being portrayed in the market, right? So Seth had this post, and this is what he said. If you think strong breadth should define healthy market highs, I draw your attention to 1987 peak, with 87.4% of stocks above their 50-day moving averages. Breadth has been all over the place during past market peaks. 2024 peak has the worst breadth of all past peaks. So I just want to throw this chart up that he had, has lots of data sets in it, and it shows how many stocks are above their 50-day moving averages. My words of wisdom here is, don't make this data point your sole decision-making process. Mm-hmm. That's why I picked it this week.
Yeah.
Your comments.
No, I don't really have anything to add. I think it's, it just goes to show you that we've been in similar places before. This isn't the first time this has happened, and we've seen plenty of different periods throughout market history where breadth hasn't necessarily been the strongest, but the market continues to do well.
That's right.
And I'm not saying the market's not going to fall 20% in the next year.
Exactly.
You just gotta.
You can't make this your sole decision making data point.
Yes,
is my biggest point here. My last piece, I think you're going to eat this up. Okay. This is from Dividendology on June 20th, okay? It's, quote, what an 8% average rate of return looks like on a compounding interest calculator versus real life, Mark. Mm-hmm. So Jenna's going to put up this illustration for our YouTube viewers. This will be in our show notes. What you're going to see at the top is this beautiful, nice and even 8% average compounding on a calculator. Shows money going in. It shows a nice and easy compounding. But then you got real life, right? And at the top of the podcast, you were talking about some of these stocks that I would argue are name brand recognition stocks. And they have exhibited massive corrections over their lifetime. And when you look at these returns, it's showing the S&P index, Mark, going back decades and decades. You have to endure and look at some of those drawdowns of plus 30% in order to enjoy a long-term rate of return in the high single digits. And I just want to throw it out there that obviously there is sacrifices that an individual needs to make to get equity-like returns. And you have to endure years like 2022. It's just the way it is. There's no magic bullet. Mm-hmm. And so with that being said, I just want to remind people, we've been in a nice uptrend since last November. Did we have a correction in April? Yes, we did. Market made it back in 2-3 weeks. We just got to remember that there's no free lunch with the stock market. Volatility at some point will return. It's normal. And that is the price you have to pay for these nice long-term rates of return.
Yeah, I think to a certain extent, that first chart that you see, which there's, it seems like hundreds of compounding interest calculators online, it leads people to believe, especially new people that are just learning or getting educated about investing, initially when you see this, you're like, oh, it's so easy to invest and save. I just got to save the money and, I'm going to be set.
Yeah.
And in reality, I think instead of showing this type of chart, we should show the what it actually looks like chart that you just alluded to, but on the same chart graphic, with the compounded interest returns.
Yeah.
But, year 1 is up and then year 2 is down. Year 3's up, year 4's up, year 5's up, and then there's a pullback in year 6, right? So I'd be interested, maybe we can get Nick to pull a graphic and just do this for the past 20 years to really show how we got to where we were.
Yeah, we'll pick like an indice. Let's just mimic the S&P just for illustration purposes. I like doing that, and I think our listeners and viewers would enjoy it. Coming out of the great financial crisis of the late 2000s, I'd argue that was a really tough psychological event for newer investors at that time. They saw the pressures that their parents were going through, wanting to retire, seeing their retirement accounts sell off so much. It was such a abnormal event when you look at history. And then all of a sudden you had this apprehension by anyone below the age of 35 to really invest heavily into 401ks. And that was a generational issue. And that took a lot of education. And I just want to throw it out there that, consistently saving, utilizing the stock market, if you have proper long-term goals and objectives, is a very, very good way to accrue wealth over time, in my opinion.
Yeah, it is. It is. Moving on to our financial planning topic of the week. This was a blog post from Jim Blankenship, who's a CFP, titled "The Problem with Naming Your Estate the Beneficiary of Your IRA." This was back on May 6th. So he says, while it may seem like a simple idea to just make your estate the beneficiary of your IRA, there's a problem that will arise if you decide to take this route. The problem is that IRAs are much different from your other assets, with special rules that apply only to IRAs, and of course, those special rules extend beyond the grave. Number 1 is the problem with distribution. In order to arrange for an extended period of distribution to your heirs, for example, a stretch IRA or the 10-year distribution period, there must be specific designated beneficiary for the account. The designated beneficiary must be a person, not an entity such as an estate. Without a designated beneficiary, the benefits have to be paid out within 5 years of the original account owner passing away, if they weren't subject to RMDs yet. So again, to remind people, if you are what we call, and again, this verbiage has gotten just so out of control, a eligible designated beneficiary, meaning that you can stretch the IRA over your lifespan. Let me back up. If me and Kenzie are married, right? Say I die right now. She will inherit my IRAs, 401ks, as if they were hers from the start.
They get dumped into her name, and then they're just hers at that point.
Meaning she doesn't have to take an RMD over the next several years or deplete the account within a 10-year period.
Correct,
but that's
sir.
because she's my spouse. She's less than 10 years younger than me. So that's an example where you can still utilize the stretch IRA provision. That's not for everybody, though. In most cases, if you're inheriting an IRA or a 401k from a parent, a grandparent, an uncle, an older cousin possibly, most likely, not all the time, you're going to fall in that category where you have 10 years to deplete that account.
From the date of passing.
From the date of passing. When you don't have a beneficiary listed on the account, as Jim is saying here, that's a 5-year distribution. So that 10-year distribution just got cut in half.
Yeah.
So, and if it's a large IRA, and even if you spread that over a 5-year period, that's going to add a lot of income to you each year.
A lot.
For the next 5 years, and your tax bill is going to be higher, and you got to make sure that you're saving for that. So again, it really helps to make a person a beneficiary of IRAs and 401ks. And I'll get to a scenario here where maybe that might not make sense. But the next problem I wanted to point out is that an estate has to pay income tax at the top rate, which is 35%, with a much lower income bracket. So, for ordinary income tax brackets right now, some people may argue that they're high, which I might fall in that camp. But if the trust is paying the tax,
You're in the high
income
brackets.
threshold is much lower. I think it's only like $20,000 or $30,000
It is that low.
of
You're
income,
correct.
and
You are
you're
correct.
You're in the 35 tax bracket.
Yes.
Percent tax bracket.
Yes.
So that's something to keep an eye on. The last thing is I wanted to point out a scenario where it makes sense to list the estate as an IRA beneficiary.
I'm all ears.
And Jim agrees. He says, if you know that there are certain post-death expenses and or estate taxes that will definitely use up the entire IRA account, then it might be okay to list the estate as the beneficiary. This will have the effect of keeping these funds from being separated out from the estate and therefore taxed to the beneficiary prior to being used for these post-death expenditures.
Interesting.
Agree or disagree?
I got to digest that.
Yeah.
I don't know. I don't know if I agree with that.
Okay. Well, maybe you can think about it and get back to us.
Yeah, I'm going to
next
think
week.
about that. That's a different. I never thought of that viewpoint before. I guess, and immediately what goes through my mind for transparency is I've been doing this for a long time. Anytime I've seen a situation where there's a default to the estate, it's always been an absolute disaster.
Yeah, it is. It is. It makes things a lot harder.
Yeah.
So, again, I'm sure there are other cases where instances in leaving an IRA
Where it's
to an
justifiable.
estate makes sense. There's just not a lot of them.
Yeah.
And for the majority of people probably listening to this, it makes pretty good sense. And it's a good idea to have a person
Yes.
as the Benny of your
Yes.
IRA. So.
Yes.
Before we end up here, Matt, I just wanted to let everybody know if they want to create their own podcast, they can use the promo code JessupWealth to get their first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code JessupWealth, all lowercase, no spaces. Also, if you're looking for an AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. Use the link in the show notes below to purchase your subscription and make life a bit easier. Anything else before we wrap up for this week, Matt?
2 days left trading-wise in the month. We got earnings season beginning in 2 weeks. Those are my main things.
Okay. Well, let's leave it here then, and we will be back with everybody for episode 259 last week. Thank you for tuning in to another episode of the Independent Advisors Podcast.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.